Hello everybody and welcome. As we like to do every week, we like to take a look at the last week's market activity, then bounce around the market and look for something to trade. Now, you may have noticed I put on a video. I just put it on today because I forgot to put it on last week. I made it and I never put it out there. So we'll do the same kind of thing at the end. Please hang on at the end, and I've got a New Year's opportunity for you as well. But anyways, let's get to the markets. So here's the SPY. As you can see, it's essentially been kind of trading in a range for most of the last couple months, kind of up and down, but really kind of going nowhere. If you look at the NASDAQ, obviously looks very similar. The only one looks kind of a little bit different is the IWM. It just seems like a little bit higher overall, kind of like it seems like it's been going slightly up, but they all look fairly similar as they usually do. So, what are we going to trade this week? Well, this week we're going to get a new lesson. We're going to learn about trading earnings. So, I'll start by going to Microsoft, who is having earnings Tuesday after the market close. So, first thing to realize, here it is right here. If you put it right there, you'll see earnings on 124 after market. So, when we make earnings trades, number one is we always want to put them on in the last 30 minutes of the market. So, whenever the market's closing in your time zone, 30 minutes before the market's closing, you want to start looking to put on that earnings trade somewhere in that last 30 minutes. The reason being is we want to center our trade around the stock price. So if we do it in the morning, the stock could move a lot before the end of the day, and then our trade is already kind of invalid for the end of the day. And I'll show you this in a second. But anyways, important rule number one is last 30 minutes of the market. If you're going to make an earnings trade, that's when you put on your trade. So let's go up to the trade page now, and there's a couple other rules along the way. The second one is we want to put it on in the shortest time frame available. So in this case, it says 5. By the time it gets to Tuesday, this will read 3. So we always put earnings trades on in the shortest expiration cycle available. We can go slightly longer, still totally doable and still valid, but really the best time to do it is in the short one. So that's rule number 2. Shortest time frame available is generally where we want to shoot for. Number 3 is we need to know what they call the expected move. Now in this platform, it tells us right here. This is called the market maker move. And you see it says plus or minus 968. Let's just make this easy and say it's 10. What that's telling us is tomorrow, this market is expecting this stock price could go up or down $10 in the next few days. So when we do this market maker move, or the expected move as we call it, we use that to create our trade for earnings. So not every platform is going to have this market maker move. So I'm going to give you a shorthand version of how we would work this out. It's a little bit more complicated than this. I'm just going to give you the shortened version. I have a course that explains this as well, but this is just the shortened version. So what I'm going to do first off is start up here. So what we do is we go to that shortened time frame up here of 5 days. So for example, on Tuesday afternoon, before you make this trade, you'll go up here and you'll buy the straddle. You'll just put it up there. You're not going to buy it. You're just going to look at it. And all the buying the straddle is, a straddle is just meaning we're buying a call and buying a put at the strike price nearest the stock price. So in this case, 240 is the stock price. So if this is where exactly where we were, let's say on Tuesday afternoon, we would look to buy the straddle at the 240 mark, because that's exactly where we're at. And what we do is we take the price of the straddle and we multiply it by 0.85, and when we do that, you'll see we end up at about 988 roughly as the price. And you can see very similar to what the actual market maker move is. So it's a great shorthand version of working out the expected move. And we're going to need this because we want to create a trade that kind of keeps the expected move inside of our range. So what do I mean by that? So let's go now to our trade. I'll get rid of this straddle. And so here's our trade. So we see that the market maker move is roughly $10. So when we create this trade, if at all possible, we'd like to be at least $10 away from the stock price, because if the expected move is $10, if we're $10 away, the goal is to have it fall within that range and we make money on the trade. So in this case, what I'm able to do is go up a little bit more than $10. So you can see here, I'm selling the 252.5 call, and on the downside, I'm selling the 227.5 put, both of which are a little bit more than $10 away. They're like $12 away, which is great. If the expected move is 10 and we're $12 away, hopefully that means we're going to make some money. And then in this case, the strike prices are 250 wide. So we're going to buy the call and the put that is 250 away. And if we do our little formula, when we work out how we work out what we need for minimums, it's always 33 cents per dollar width. And in this case, it's $2.5, and that gets us to around 83 cents is what we want to collect on this trade to make it a valid trade. Now, just to let you know, on earnings, it doesn't need to be exactly 33 cents per dollar. These are short, very high risk, high reward trades. So whatever you're comfortable with, if you're happy at 75 cents, totally fine. I try and stick to the rules as much as possible, but in earnings, there's a little bit more leeway. So back to where we talked about. Let's kind of run through this whole thing. Tuesday afternoon, from the 30 minutes onwards, last 30 minutes of the market, we're going to go to Microsoft and look at the trade. We're going to buy a straddle at whatever number this says. So if it said 250, we'd buy the 250 straddle. We'd look at that amount, multiply it by 0.85 to get the expected move. Then we're going to look to move our short call and short put at least that far away. So right now it's 10 bucks. 10 bucks is great, but if we can go even further away, in this case we can go to 12.50 away almost on either side. And we're still looking to collect our 33 cents per dollar width if possible, but there's a little bit more leeway in earnings because these are one-day trades. What's going to happen is tomorrow when the market opens, it's going to do its expected move, and we're going to look to close this trade within the first 10 minutes of the market opening. We don't hang on to these trades for the most part unless they're full losers and there's nothing else to be lost. If it moved 50 bucks, well then we'll just hang on to this to the very end and hope it comes back. But generally speaking, we open them in the last 30 minutes of the day before earnings, and as soon as earnings happen the next morning, we want to close these within the first 10-15 minutes of the market opening. And that is an earnings trade. And please hang on now for a little special New Year's deal as well. And welcome to an opportunity I don't think you're going to want to pass up. Now, the point of all my courses is to give you the knowledge base and the confidence to learn to trade on your own and hopefully one day generate an income stream on your own through the options market. But the best way I've found to do that is to allow you to trade side by side with me. So the way you do that is if you go to sharpertrades.com and you go to the products section, two alerts will show up, the basic alert and the pro alert. Now the alert itself is the same for both. The only difference between these two is the Pro will give you access to every course I've ever made, many of which aren't available anywhere else. Now the prices, if you were to do it right now, would be $49 a month and $99 a month. But I'm so intent on getting you up and running as quickly as possible that if you go now to sharpertrades.com and you type in this code, you will get it for $1 for the first month for the basic alert. And you can cancel it anytime. So if you decide you don't like it after the first month, go ahead and cancel. If you like the alert and find value in it, from month 2 onwards, it'll click into $49 a month. Now the alert itself will send out 2 to 3 alerts per week, trades in real time, and they'll also send out all the alerts as far as managing the trades for the best possible profit opportunities. Again, you'll get 2 to 3 real-time trades per week, and any trades that are managed correctly for profits, you'll get those alerts in real time as well. So I really believe there's no better way to get up and trading as quickly and confidently as possible beyond sitting next to me essentially and watching me trade and trading alongside me if you like. And again, I'm so intent on getting you there that I'm willing to give it to you for $1 for the first month to make sure you're comfortable with it. And if you're not, again, you can cancel at any time. So please jump on this opportunity. I really believe it'll get you up and trading as quickly and confidently as possible.